I mean, look, I'm a fairly simple soul. I just say, get the hell out of credit, just get into gold or silver. Rick actually is more at the coalface, analyzing companies and all the rest of it. So that's probably where the leverage is on this extraordinary story at this moment in time.
I just think it's self-defense for the institutions. If you believe, as I believe, that in this sense past its prologue, that the US dollar will lose 75% of its purchasing power over the next 10 years, like it did in the decade of the 1970s, and I believe that. I think it's reasonable to suppose that the nominal price of gold, when I say nominal, I mean US dollar price of gold, will increase in a way that mirrors that. In the decade of the 70s, the last time the US dollar lost 75% of its purchasing power, the gold price ran 30-fold. Now, I'm not suggesting that over the next 10 years, the price of gold runs 30-fold, because as an example, since the year 2000, it's already risen 13-fold. Personal financial planning over time is a very long-term endeavor, but the arithmetic around it is fairly simple. The second thing is that talking to either Alasdair or myself about retirement is fairly foolhardy. Both of us have failed completely. It's important to note that when Social Security was instituted in the United States, its mandate was to provide basically poverty-style existence for people above the age 65. And the median life expectancy of an American male when Social Security was instituted was 66 years. Demographics has changed. And so it makes perfect sense that people would need to prepare to live longer. I don't recommend retirement myself. I enjoy working. Let's just say that my mind needs to be either stimulated or sedated. Working for me is much healthier than drinking, and the consequence of that is that I like to work. On a more serious note, I think that if you look at the solvency of various retirement systems, including Social Security, that you come to the conclusion that you need to take care of your own retirement. If you are American, you need to bear in mind that according to the Congressional Budget Office, the net present value of unfunded entitlement obligations in the United States exceeds now $120 trillion. This number doesn't come from a balding, fat, cranky old libertarian. It comes from the Congressional Budget Office. Now, to put that in perspective, gross federal income is $5 trillion a year.
The numbers paint a sobering picture. According to the Congressional Budget Office, U.S. unfunded entitlement obligations now exceed $120 trillion. Compare that with just $5 trillion in annual federal revenue, and the imbalance is staggering. Even before considering other liabilities, the math makes it nearly impossible for the government to meet these promises. Pension funds face their own dilemmas, locked into low-yield bonds while inflation erodes real returns. Selling assets means losses. Holding them ensures insolvency. It is, in every sense, a trap. The lesson is clear. Relying on public systems alone is no longer a safe strategy.
What do you think the probability is that the United States, and Alasdair will have to give the European or British numbers, but what do you think the probability is that the U.S. government, with $5 trillion in gross income, and of course a government and a nation to run, can honor $37 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities? Think about the arithmetic around this. And think about despite the fact that you paid into Social Security for 40 years, which is irrelevant, there isn't enough money to take out. Think, too, about some other form of retirement entity, perhaps private, that invested the bulk of their proceeds in 20 or 30 year debt obligations, yielding some number like 4, 4.5, or 5, where the underlying inflation rate is 8. The managers are in for a tough spell. If they sell those low-yielding instruments, they take hits to principal down. If they hold them, they guarantee the fact that they can't fund their obligations over time. Talk about a rock and a hard place. So understand where you are, understand who you are, and plan accordingly. It's your only chance.
As traditional pensions falter, investors are seeking defense against currency debasement and systemic risk. Precious metals, especially gold and silver, have historically preserved wealth through turmoil. Unlike ETFs or paper claims, physical ownership provides direct security, free from counterparty risk. Beyond that, industrialization in emerging markets, led by nations like China and India, is fueling massive demand for base metals. Copper, nickel, and silver are essential for energy transition and military technology alike. This shift in global consumption means real assets may once again outperform financial assets. Protection, therefore, lies not in promises on paper, but in tangible, enduring stores of value.
Broadly, I think what Rick says is absolutely right. I mean, anyone looking at a pension fund is actually on a loss, or a loser. The only thing you can really do now is protect yourself against the declining purchasing power of currencies. And the only way in which you can do that is to buy physical gold. I mean, I would prefer ownership of gold rather than indirect credit through an ETF. And the other thing, I think, is to look at maybe some other commodities, because the one thing that's happening, which we just don't understand in the West, is that there's a whole world out there being run by, dare I say, China and Russia, are sworn enemies, but they basically are assembling the majority of the world's population, and they're going to industrialize it. And that's going to require an awful lot of base metals. It's going to require also gold and silver for monetary purposes. And so that's the area where you've got to look. And we haven't had any sort of move out of conventional investments into these defensive sectors. And that, I think, is going to be an interesting challenge, particularly when you understand that equity markets are basically being sustained by a credit bubble. I mean, just look at what's been going on with the leverage, if you like, the debt leverage through loans, to investors who have been leveraging up in order to improve their returns on, presumably on the Magnificent Seven or whatever. They're so greedy.
Meanwhile, stock markets appear increasingly detached from fundamentals. Much like the dot-com frenzy of 2000, momentum and leverage are driving valuations far beyond earnings reality. Margin debt in U.S. markets has surpassed $1 trillion, signaling a dangerous dependency on borrowed money. Equity valuations remain artificially elevated by easy credit and speculative fervor. But as history shows, from 1929's crash to 2008's collapse, credit-fueled bubbles eventually burst. When they do, liquidity vanishes and investors scramble for safety. With less than 0.5% of global assets currently allocated to gold, the world remains dangerously underexposed to traditional safe havens.
I mean, the latest figures from FINRA looks, I mean, you're looking at over $1 trillion outstanding there. Now, that's got to be unwound. And it will, I mean, it's a sign, if you like. It's the clearest sign that this is a credit bubble. And if you look at the behavior of investors, I mean, they're just chasing momentum. Who gives a damn about value? That's not the way to go. So it reminds me so much of the dot-com bubble back in 2000. So all the symptoms are there, the psychology and everything else. And then on top of that, we've got President Trump's beautiful tariffs. And I tell you, this just reminds me of 1929 when we had, the Roaring Twenties, which was the puffing up of credit, the credit bubble. And then you had the collapse from a high point, I think in September 29. Market lost 90%. And guess what? We had tariffs as well, Smoot-Hawley Tariff Act. That came in. The whole situation is so reminiscent of that. But this is far larger. This is a dangerous time. But at some stage, investment managers are going to realize they're doing completely the wrong thing. And I think it's just beginning. For example, you see major banks like Goldman Sachs, Bank of America, Citicorp, whatever, now saying gold's going to go 4,000 or 4,300, or whatever they say. But think about their poor clients. They haven't got any. I've been knocking on the door and saying, look, your analyst is saying gold's going to 4,300. What have I got?
The US dollar has lost over 90% of its purchasing power in the past century, and another wave of erosion may be underway. If inflation continues at today's trajectory, the dollar could lose 75% of its value within a decade, echoing the 1970s. During that era, gold surged 30-fold. While a repeat of that scale is unlikely, a 3- to 4-fold increase is plausible. In practical terms, gold acts not as a speculative play, but as a form of savings, an anchor in a world where paper currency steadily deteriorates. Owning gold may prove less about gain and more about survival.
You've just got me the wrong bloody stuff. And this will be acute when that credit bubble pops. Because I tell you what, it's going to be a very nasty scene in industrial equities, in stocks and all the rest of it. And I don't know how much people will be able to get out. But at the moment, on average, if you look across the roughly 300 trillion of investable assets, less than 0.5% of that is in gold. They've got it completely wrong-footed. So I really think that the next few months, and I think it's that soon, the next few months are going to be extremely interesting from the point of view of the switch, if you like, away from, the current winners, which will become suddenly, like cyanide to investors, into obviously what's already running, and they just haven't bought it. So it fascinates me that, look, I'm a fairly simple soul. I just say, get the hell out of credit, just get into gold or silver. Rick actually is more at the coalface, analyzing companies and all the rest of it. So that's probably where the leverage is on this extraordinary story at this moment of time.
I just think it's self-defense for the institutions. If you believe, as I believe, that in this sense past its prologue, that the US dollar will lose 75% of its purchasing power over the next 10 years, like it did in the decade of the 1970s, and I believe that, I think it's reasonable to suppose that the nominal price of gold, when I say nominal, I mean US dollar price of gold, will increase in a way that mirrors that. In the decade of the 70s, the last time the US dollar lost 75% of its purchasing power, the gold price ran 30-fold. Now, I'm not suggesting that over the next 10 years, the price of gold runs 30-fold, because as an example, since the year 2000, it's already risen 13-fold.
Despite gold's importance, history warns against overconcentration. Even in past bear markets, investors like Warren Buffett generated strong returns through disciplined equity selection. The key is balance. A prudent allocation to gold, combined with diversification across cash, commodities, and selective equities, can shield portfolios from systemic shocks. Today, gold represents just 0.5% of global assets, well below its historical 2% average. A return to the mean alone could spark a surge in both demand and price. The message is simple. Financial security requires foresight, resilience, and adaptability. In uncertain times, those who plan wisely will endure.
But I am suggesting that the increase of the gold price, the nominal gold price, may likely mirror the decline in purchasing power of the US dollar. If that's true, the nominal gold price would increase 3- or 4-fold in the ensuing 10 years. If that happens, a reasonable allocation to gold can hedge a lot of the portfolio deterioration that you would experience in other parts of the portfolio. I want to say, too, that this isn't the only way up the mountain. I personally save in gold, but I maintain liquidity in US dollars. There's a very, very, very big difference between saving and maintaining liquidity. I don't own gold because I think it might go up. I own gold because there's been a golden constant. If you save in gold, if you look at home prices, or if you look at grocery prices, or you look at anything in your budget, save tax, you're surprised at how cheap things are measured in gold in the period 2000 to 2025. I think, too, that it's possible to over-allocate to gold. I know that'll be travesty in this call, but I note in the decade of the 70s, in the middle of an equities bear market from 1968 to 1982, a 14-year-long bear market that both Alasdair and I were part of, the Warren Buffett, who believed that gold was a pet rock, generated 24 or 25% compound internal rates of return over time. I would suggest to you that gold is merely a component, albeit a major component, of the strategy that will get you through the next 10 years. Alasdair mentioned earlier that on a global basis, allocation to gold relative to other savings and investment asset classes, according to JP Morgan Chase, is about 0.5%, despite the blandishments of the Harvard endowment. The 4-decade mean market share is 2%. If ownership reverted to mean, at least in the U.S. market, that would result in a 4-fold increase in demand for precious metals and precious metals-related securities. I'm not smart enough to tell you what that would do to the price, but I think it would be interesting. Again, I had a phone call with a former client a couple days ago who is now 100% in gold. This is daft.